A balanced portfolio should have a little bit of everything, especially as you build your wealth and you have a larger and larger net worth. You don't want all of it in purely stock equities. And you definitely don't want all of it in bonds or, all of that nature. You want to have a little bit of everything to maximize your return while also protecting your downside risk. There are specific investments out there built for downside protection or benefit off of volatility spikes.
Welcome to the Stock Alternatives Podcast, hosted by Jeff Stock, actuary, investor, and private wealth strategist. This podcast is dedicated to helping investors save on taxes, reduce risk, and grow wealth through private wealth strategies and alternative investments.
Hi, my name is Jeff Stock. This is the Stock Alternatives Podcast, and today's guest is David Tran. Did I pronounce it correctly? Is it Tran or Tran?
Tran.
Tran. Sorry about that, David.
No worries.
We usually ask these questions ahead of time. So David is a tax strategist, expert tax strategist. He helps people who make $1 million or more to save significantly on their taxes through a combination of strategies that the client can choose to some extent which ones they want to choose. So David, tell us a little bit, how did you come into this profession and what were you doing before doing tax strategies?
Yes, good question. So before I got into tax strategy, the place I was in corporate. I myself used to be a W-2 employee, and I was used to seeing 40% of my income go to taxes every year. I live in California, one of the states with the highest rates of marginal state income taxes. So you can stack that onto the federal, and you end up in positions where a lot of people, like my peers around me, were paying 40% of their income in taxes. And for many years, me and all of my peers just thought this was ordinary and these are the things that you had to do as a citizen of this nation. And then it only came to me years down the road that I realized actually there's legal ways to pay less once you understand the tax code. The tax code has all sorts of provisions that allow you to get tax benefits for doing things the tax code wants to encourage. For example, they always want to improve the overall economy as a whole. So they're willing to give tax benefits to some who stimulate the economy, create new jobs, offer new opportunities that didn't exist prior, advanced research and development, those types of things. I left tech in 2020 to start my own consulting company, and our first audience to serve were software startup founders. Similar to my background, a lot of software developers who transitioned to entrepreneurship, their specialty is in the product building, and they had a lot of needs elsewhere, either operationally, financially, legally, etc. And to the extent that I could help these people, I was trying to help in every way possible. There wasn't a formal scope as to what my work was, but over time it became to go more and more down the path of tax and financial optimization. And hence, that's why I decided just to pivot and make an entire firm dedicated to serving that need.
And in your experience, David, how many professionals are doing tax planning and how many CPAs know about these strategies?
Industry is small. So I think the last time I checked, the population of America is roughly 380 million. There's just not enough accountants to go around. And one of the famous stats that goes around the accounting world is that 70% of current accountants will retire in the next 10 years. And that's just accountants broadly. A small sliver of that is going to be people who are actually in the tax advisory space, so people who work with clients, generally those who make larger sums of money and have the opportunity as well as the willingness to invest into tax advantage investments to get these tax savings. So I actually don't know the exact numbers of how many people are in the industry, but I do know it's relatively small. And it's part of the reason why a lot of people haven't heard about these things. There are social media influencers who talk about tax optimization, but as a whole, whenever I talk to new prospective customers, a lot of times they've never heard of any tax strategy before, despite making $1 million plus.
Exactly. So that's part of the reason why David and I can work together is because there's so many people who need help with saving money on tax.
There are indeed so many people that I feel no sense of competition by however many advisors there are. Yeah.
It's not unpatriotic to find ways to save on taxes either. We love helping the government and paying our fair share of the taxes, but when we have strategies, these are usually to promote things that actually improve the country and improve the world as well. So there's a lot of strategies on clean energy, clean air. There's strategies on economic development. David, tell us about some of your favorite strategies.
Yes. So I have favorite strategies that I think in terms of their economic outlay, and I have favorite strategies in terms of their impact on society. I'm happy to talk about both. So for example, I'm a big fan of the short-term rental, what social media calls a short-term rental loophole. It's really not a loophole. It's just something that's built into the tax code, and with Trump's restoration of bonus depreciation being 100% permanently, it just becomes almost a no-brainer tax strategy for anyone who even looks at tax strategy to consider. it is one that requires a bit more liquidity in the sense that short-term rentals can be quite expensive if you want to maximize a full array of tax savings, but it's one that helps you build your wealth while optimizing your tax savings at the same time. So assuming you get assuming you're in that 35 or 37% tax bracket, every dollar of deductions gets you a 35 or to 37 cents reduction of your taxes owed, and that's just a massive win. You can functionally think about it as getting real estate for a discount while you still get the full value of its cash flow and appreciation over time. In terms of strategies that I like for their impact, there's a lot of donation-based strategies that just move more money into the hands of nonprofits. Like you mentioned earlier, Jeff, like we're not unpatriotic here. Like the reason I do what I do is I want to benefit society. And I think politics aside, there's just plenty of studies that show that the larger an organization gets, the less efficient it becomes at a lot of things. And I think that can be applied to the US government. So I think local nonprofits who have a very specific cause and specific focus, who are driven primarily by volunteers and not by paid members, or can use these funds in a more efficient way, where the funds go directly to benefit the causes that are being supported. And I think for me, whether it's helping animal-based charities or charities of people who are disadvantaged in life, I think all of that is a dramatic win for society.
So if someone gives money to charity, right? Say you're paying 37% to federal, and you're in California, so you're paying
an extra like 11%. Yeah,
you could have a tax rate that's coming up on 47%, almost half your money. So I mean, I agree that it's good. So you give a charity $1 million, or we'll be more realistic, $100,000, and you're going to get back $47,000 in tax savings. Is that accurate, or are there some other strategies where you can get more back in tax savings than what you donated?
That is the typical way it works if you're donating cash to a charity of that amount. There's all sorts of ways to be creative with it. So you can, for example, you can take a loan to donate more money to charity. You can donate assets instead of donating cash. And more or less, there's so many mechanisms in the tax code that allow you to get donation deductions, even if you're not specifically donating cash itself.
So if you donated assets, could I donate my art collection and have somebody buy?
Some people do donate their art collection. When a part of my work is a lot of legal studying, and when you look at the court case track record of people who've done these types of things in the past, you can kind of see how what's been done before is probably gives us guidance as to what is doable today. And art is a classic category of donations. I personally am not an artist. I don't pretend to be an artist. I struggle to draw a perfect circle. But it's one of those things where there is a world of artists and a world of genuinely valued art. I don't personally like to delve in this space because I don't like to invest in things I don't understand, that traditional Warren Buffett principle. But there are people who are art experts who do invest in art, hold on to these assets, and sometimes they sell them years down the line, and sometimes they donate them years down the line. As long as you're getting a qualified appraisal by a third party who is an expert in their field, generally that appraisal is something that you can take, apply to your donation, attach it to your tax return, and get a donation deduction of what that appraisal claims.
So it's all about finding someone who's going to appraise it nice and high.
That is something that people have tried to do, where there are people who are less than scrupulous appraisers who specifically try to work with people who are trying to abuse the system and artificially assign really high values. The way it works is that, yes, you're allowed to put that into your tax return, and that is technically what you submit. The IRS also has their version of it too. So for example, if they want to challenge your valuation, they're actually free to do so. There's a sub-team within the IRS specifically dedicated to art valuation because as you can imagine, it's open to abuse. And whenever there's an opportunity for abuse, the government wants to be smart about things to allow fair play, but penalize bad actors. So you're going to see situations where people think art is worth $100 million, and the IRS auditor, the art team from the IRS team, might see it as $10 million. And ultimately, they're just trying to come to a fair conclusion as to what the art is worth, so you can get the proper donation deduction for the actual benefit that you gave to the charity. I think everyone here is all in favor of supporting charities. We just want to make sure that you get a proportional benefit to what you're proportionally giving to the charity.
Yeah, that makes total sense. What are some other things that you've seen people donate that could potentially be worth more than just cash?
I've seen people donate land, conservation easements, both in their syndicated and non-syndicated formats. have been really popular over the last few decades. I would warn people against syndicated conservation easements because they are a listed transaction, which doesn't mean that they're inherently illegal. It just means that the IRS has seen a lot of abuse in this space. And when they see a lot of abuse in this space, they'll make something a listed transaction to notify the public that, hey, this is probably something that you should do a lot of scrutiny on, and that they can roughly expect an 80, 90, or maybe even 100% chance of being audited. And a lot of people just want to avoid that entirely. Hence, I don't choose to delve into that space, but it still does exist. And some advisors still like to operate in that space, especially if they know that their version of this is legitimate and the valuations are defensible. Ultimately, it comes down to that defensible valuation.
David, do you recommend working with a CPA to help make sure that you're not going to get audited, or is this something that, like, what's the approach that you would use to protect yourself from the IRS kind of looking into your business?
So the IRS is allowed to look into your business. They have that privilege for everyone. I think about it the same way I think about going to the airport and like going through TSA security. If you have reasons for them to suspect you, they probably will pull you out of the line and do a manual inspection. But also on top of that, there's also just going to be random inspections. There's no clear reason. You just happen to be the person that got randomly selected for a manual inspection. Same thing with the IRS. If they have reasons to think that you should be audited, they'll probably audit you. And if they don't think there's any reasons to audit you, then you will have a tiny chance of just being audited through sheer chance. That latter part, that's unavoidable. The former part, you'll want to make sure that the value of a CPA is making sure they file things accurately. So an accurate return is likely to minimize your chance of being audited because everything is as properly reported. And a part of a CPA's work is making sure that all the stuff in their tax return is defensible.
And so I'm going to change topics a little bit. So you work primarily with W-2 employees or business professionals? And then what are some of the differences on what you can do as a W-2 versus as a business?
So I started off in the space of business tax advisory just because I was working with a bunch of software startup founders, and then they would introduce me to their startup founder peers. And then those would eventually introduce me to other business owners as well. And I stayed in that space for a while, and I really enjoyed it. The reason I moved over to personal tax advisory, namely for smaller businesses. So I do work with small business owners, think about like less than 100 employees, as well as W-2 employees. And the reason is that personal fulfillment element. When you work with a lot of these software startups, you want to hope for their success. But a part of their success means they also explode in terms of their revenue, explode in terms of their team size. And I was working with different people year after year as the company grew. And I think for me, I prefer working with the same individuals year after year, hence the transition over to personal tax advisory. As for what are the differences between the two, the same strategies that exist for business owners can exist in a smaller scale for W-2 employees, but there's this thing called the excessive business loss limit. And it more or less limits how much a person whose primary income source is a W-2 can reduce their taxes in the current year using a business-based strategy, for example, that relies on things like depreciation benefits. Whereas on the business side of things, because they're hopefully a profitable business, they would have the excessive business loss limit is less relevant to them. So the goal for a W-2 employee is look for all the different levers that we can pull to minimize their taxes. Whereas on the other end, for a business owner, you can actually bring your taxes all the way down to zero, at least at the federal level. State performance will vary depending on the state, but at the federal level, you can bring your federal income taxes down to zero, which is not something that's doable for a W-2 employee. And for a lot of people, it comes down to what's the efficiency to bring my taxes down to zero. And typically, they don't necessarily need to bring down to zero. If you have about like $100,000 to $200,000 of taxable income, the effective tax rate on that is low enough that's not worth mitigating. But for a W-2 employee, if you're making, for example, north of $1 million, you really can't bring your taxes down to zero.
So I have a question on that. So say someone actually is really, really good at reducing their taxes and they bring their taxes down to zero. Is that worse than maybe having $10,000 in taxes? Because I'm wondering, like, if you bring it down to zero, you might be showing no income, and it might be harder to get approved for like buying cars and doing other things that you need income for.
That is an element that I do tell clients about. So one of the things is a lot of lenders out there, especially the mega banks, you can think of the Chase, the Bank of Americas, the Wells Fargos, they have an algorithm. You hand them a document, the algorithm takes that document and then spits out a number. That number is going to be in terms of like how much you can borrow and what the interest rate is. That's just kind of how these firms work. If you have a closer relationship with your bank, you can ask them to manually underwrite things, at which point they want to see the fuller set of circumstances. Depending on how much you have with these banks, they may entertain that, and maybe they won't. I usually recommend my clients to work with mid-sized banks instead if their goal is to optimize a loan, especially for something like a home purchase, where the AGI on your tax return becomes a very relevant number for their algorithm. A lot of tax strategies will reduce that through artificial losses, things like on paper losses through depreciation benefits, even though it's not like the client themselves made less money. That leads them to be in a position where they want to be able to have a closer relationship with someone where they can explain the reason, the reason my AGI is this way versus this way is because I was applying a tax strategy. And a lot of the mid-sized banks are more open to understanding that, and they'll manually underwrite things in a way that's favorable versus unfavorable.
Got it. Would oil and gas be an example of a strategy that would lower your AGI?
It is an example of a strategy that would lower your AGI, and a lot of people think about the strategy predominantly around November or December, where they're trying to get beneath a certain threshold. So, for example, one of the recent tax code changes was the SALT cap limitations. So previously, you're limited to only deduct $10,000 of your state and local taxes from your federal taxable income. However, they recently made a change so that the ceiling is now $40,000, and this is really relevant to a lot of earners in California or New York, where the state taxes are really, really high. And that difference between $10,000 of deduction and $40,000 is quite significant, especially for people who are homeowners and pay a lot in property taxes. So for those folk, they get the benefit of a larger amount if they can bring their AGI beneath a certain amount. Thus, things like oil and gas serve a good purpose there.
So what is the threshold for your AGI?
You're going to want to be below 500,000 to make sure you can maximize that benefit. So when clients come to me and their taxable income is around that 600K range, if you just invest enough into oil and gas, you can bring your AGI beneath that 500K threshold so you don't get phased out of the benefit.
That makes sense. So they can invest maybe like 200,000 in oil and gas, and they'll get an offset to their AGI of about 170 or so of that.
That's right. And then the way I work with my clients too is that sometimes, obviously, from a dollars in, dollars out perspective, you're like at a loss in the sense that you put $200,000 in and you get I call it 160K write-off, which probably translates to around like 50K in tax savings to 60K in tax savings. You're still net negative in terms of cash flow position. And that's why I recommend tools like stock-based loans, credit lines, home equity lines of credit, especially because you can write off the interest on that because you're using the loan to make an investment. The government allows you to write off the interest as a tax deduction while also getting the benefit of the tax savings without having all the money be out of your pocket yourself. And
then do you do taxes for your clients, David, or do you have partners that do taxes for your clients? And if someone wants their CPA, are they allowed to do that?
I'm of the mindset that if someone's applying a tax strategy for you, at the very minimum, they should offer to also file your taxes. If they don't offer to file your taxes, if they have a separate engagement, or it's okay if they have a separate engagement, but if they don't file the taxes and they push you off to another firm, I do think of that as a yellow flag in some cases. Sometimes it can just be purely an efficiency thing, but sometimes it also because it means the tax strategy may not be fully defensible. You want your accounting firm to take full ownership and accountability for the things they're submitting to the IRS. Submissions can only be done by licensed professionals like CPAs or like enrolled agents, and you want to make sure that someone with their professional judgment is agreeing with all the stuff that's in the tax return when they submit it to the IRS so that the odds of an audit are as low as possible, as well as no loss of information between the parties exist.
That makes sense. And then for strategies you use, do you get like an attorney opinion letter or a CPA opinion letter?
That's pretty common. A fun fact to know about this industry is that legal opinions don't generally work the way people think they work. Investors think that if there's a legal opinion associated with a particular transaction, that legal opinion protects them. It does not. The legal opinion is more so just simply that, an opinion. For a legal opinion to specifically protect an individual investor, they need to get the legal opinion uniquely addressed to their circumstances, not broadly talking about the strategy as a whole. That said, legal opinions still have their place. They help people like myself who are not attorneys to digest all the legal details and understand the legal nuances that need to be present to be compliant with the tax code. So it's useful as a tool for the advising firms to understand how to to view strategies, but in terms of is it useful for investors directly, usually not. There's usually so many clauses in these legal opinions such that they don't actually provide any meaningful protection. It's more of an informational guide.
Okay. Can you tell me a little bit about what you know about clean energy credits and solar, and a new one now with the EV with the batteries, or just battery powered technology for clean energy?
So a lot of people, one of the most common ways that people get into the space of tax arbitrage is through solar. And the reason you can find examples of tax arbitrage is because the government wants to incentivize clean energy infrastructure across the nation. Different territories around the nation will also have additional tax credits associated with clean energy because the government wants to nudge more people away from the stuff that damages our environment and more towards the renewable stuff. That includes things like solar energy, it includes wind, it includes thermal, it includes battery backup systems. All these things form this broad category of assets that get these clean energy tax credits. These clean energy tax credits are available, they're available for business owners. They are taken away for personal use cases. So 2025 was the last year that you can get a solar panel on top of your own roof and get tax benefits for that. However, you can still buy solar panels, battery backup systems, et cetera, as a business owner, lease it out to another party and get the tax benefits for that. That's still going to be ongoing for the next few years. And the idea behind it is once you think about the structures about how these are made, there's usually this intelligent structure where it's either going to be in the form of the investor takes on a loan to buy more panels and or takes a prepayment from the counterparty that wants to lease the panels to lower their cost of their investment so they can get a larger amount of solar panels, which entitles them to a larger amount of solar tax credits. Generally speaking, you can find somewhere in the range of $1.20 to $1.50 of tax benefits per $1 invested through solar. And the idea being, just for simple math here, this is not precise down to the T, but let's say you owe the government $150,000. Instead, you can invest $100,000 into solar and then pocket the extra $50K yourself while satisfying your tax liability.
And then would that also produce a return if you're putting $100,000 into solar?
That's right. It depends. I've seen structures where it does produce a profit monthly, and I've seen structures where it doesn't produce a profit monthly. They'll have slightly different economics and slightly different areas. Different partners have different focuses. So some people like to optimize for tax credits. Some people like to optimize for depreciation benefits. And depending on any one offer, the numbers can go in slightly different directions.
Which section of the tax code would someone want to research if they were looking about solar and battery storage and things like that?
Yeah, so there's this thing called Section 48E. It's the area that talks about the tax credits associated with these solar and clean energy investments I've been talking about. There's an older version of it, Section 48. Some older projects will classify under that category, which has its similar but not identical tax benefits. And then 48E is the revised version that has a wider definition as to what is a clean energy asset, and it just exists further into the future in the tax code.
And are there incentives for some of the strategies to be American made or built in the US?
There are some bonus tax credits that exist for those types of things. The bill of materials is very strict. Like if you don't meet the thresholds, you're not entitled to the tax benefits. And the way I think about it for clients is at any given time, there's different projects that are available. Obviously, choose the one that has the best tax incentives for your situation for that time in history. The supply and demand curves intersect at different points at different times of the year. So sometimes of the year, it's harder to find a project that has those bonus tax credits associated to American-made materials, and sometimes it's going to be easier depending on where in the year. Generally speaking, the earlier the year and the better. But if you're talking about like October, November, December, you just take what you can get at that point.
Yeah. So if you plan early, there's
That's
more
right, yeah.
available for people. Do you have any incentives for people who act early, like with your company? Do they get a better deal or?
I've thought about that. I've toyed with it in my mind. I've decided to not do anything. I think I try to price the same way I would like to think about myself. I like to think of myself, we're all consumers. We all consume different services and goods of other companies. And I think I want to price things the way that I think I want to be priced personally. So I don't really, I think the idea of having, I want pricing that's relatively consistent throughout the year to reflect consistent levels of effort. I do recognize my clients talk to me more in certain seasons of the year and less in others, but it doesn't mean there isn't work that's going on behind the scenes to prepare for all the things that are going to get them the ultimate outcomes that they're looking for with working with me. The way we've decided to go is the opposite direction. So, for example, last year, generally in the months of August onwards, I'm on calls. I'm probably between 14 to 20 calls per day. And more or less, it's a mad rush because everyone's just trying to fill in and do something to reduce their taxes before the calendar year ends. And in practice, it really just means September and October are really heavy months because you need to have these assets placed in service by December 31st, not just acquire the assets. Which means that it takes about 2-ish months to make sure all that happens, make sure all the things are compliant with the tax code. So those months are really heavy. So instead, we decided to do a rush, kind of like a rush processing additional cost for those people who come later in the year. And then if they were to renew the following year, if they were to pay in the first half of the year, they'd get back to the baseline price point.
That makes total sense. Are there some things that say you missed the window, right? Like, can you go back in time and recover the taxes?
I get that question all the time, and the true honest answer is it depends. But for 99% of cases, you cannot retroactively go back and apply a tax strategy. There are 2 instances I can think of off the top of my mind where it makes sense. The one option is to amend a prior return. So a lot of times when a new client onboards with us, we look at their prior 3 years tax returns, and if we see an opportunity to catch something that they might have missed, particularly for a lot of clients who self-filed through TurboTax for years prior, they're just not aware of all things they can do. And TurboTax, as friendly as a software as it is, it doesn't offer everything that truly exists in the world in terms of tax optimization. Primarily because it is meant for the general consumer who may probably make somewhere in the range of like middle class income to upper class income, but it won't really serve those who really make higher levels of income. And then the other time is if you have tax credits coming from solar, you can roll those back up to 3 years. So the idea being, if you were to invest into a solar panel in 2026, you would use your tax credits first for 2026, and whatever you didn't use this year can be rolled backwards up to 3 years. That's the only instances I can think of where something can get rolled backwards for a typical like W-2 client.
Great, yeah. So that would mean solar, batteries, wind, all those 48E.
That's right, yeah.
Okay. And then if someone's using a 48E investment or a short-term rental investment or one of these donation investments that you guys have, can they do their own taxes like with TurboTax and just figure it out, or do they really need a professional?
Legally speaking, there's nothing stopping them. The tools are all there. I've never personally tried using TurboTax to file something more advanced through. I trust that you can probably get most of the way there, maybe even all the way there. But the difference between whether the software allows for it and the person doing it correctly is the primary thing. Something to note is that, and these numbers will vary based on the survey you look at, but the error rate for a tax return is in the double-digit percentages for a typical W-2 client of an upper middle class or upper class background, just because a lot of times these people aren't tax professionals and they're just self-filing off of the questions and the best of their knowledge. They're not filing according to like the same knowledge that an enrolled agent or CPA is held to. So it's just more likely that the accuracy is going to be significantly higher going through someone who knows what they're doing, especially someone who works with the same strategy on the regular.
Got it. So it's helpful to know which lines to put the numbers into.
It's important. So people think about accounting as like putting numbers into boxes, and while that is true, putting the right numbers into the right boxes and then checking off the right boxes and doing the right calculations is what makes a good accountant a good accountant. It's making sure that it's not just the copying of numbers, but it's the judgment of being applied. So for example, when you file for solar tax credits, there's different categories of assets, and you need to make sure that you're filling out the paperwork correctly. And it will ask very specific things, for example, how much energy is being produced by the panels that this taxpayer owns. I think the average taxpayer would have to like dig pretty deeply to find that because it changes the classification of the tax benefits. And the idea being an accountant who files this on the regular should have those details on hand or know to ask them versus having this back and forth. So on top of accuracy, it's also you just want a more streamlined experience in the tax filing experience, and hence CPAs will just know all the right questions to ask up front.
So what are some of the barriers that people usually have to deploy a tax strategy? Is it things like loans, or is it liquidity, or is it the 100-hour rule, or what other things?
There are many layers to what stops people. And I think the first layer is lack of awareness. So the idea is people grow up, generally speaking, or surrounded by certain other people around them, and they kind of learn from each other. And if everyone is all paying their taxes based on whatever the government withholds, then they assume that's the default situation. And it is the default situation if you do nothing about it, but they also didn't learn that there's ways to reduce it. So for example, ever since I was a kid, my father would always introduce me the fact that he uses real estate as well as his real estate professional status to reduce his taxable income for the family. And I think even as a kid, I knew that, okay, cool, if there's legal ways to do this, then I want to do that when I start making real money. As an adult, surrounded by other professionals, I realized, oh, this is actually not a common experience in other people's childhoods. And hence, they just don't have the knowledge that there's certain asset classes that come with tax benefits. So that's layer number one. Layer number two, maybe liquidity. I think people have the knowledge. Actually, let me take that back. It's not liquidity. It's the level of effort that needs to be applied. Human nature is where an object at rest stays at rest. Like we don't necessarily want to introduce changes because it feels scary. Change feels scary according to standard human nature. So the idea of paying less in taxes is actually a big fear of a lot of people I talk to. They feel as though by reducing their taxes, it would increase the chance of being audited. And I have really two responses to that. One of which is like, if you can legally pay less, why would you not want to pay less? And the second thing is audits are actually not the end of the world. Audits are just a sign of a healthy system. At some level, people fear going to the doctors out of fear of what the doctor might tell them, but the reality is that situation's already there. The doctor just shine light on something. In the same way, I think it's healthy for a flourishing economy to have a checks and balances system where people don't lie on their taxes. And generally speaking, if you are an honest citizen who's just filing your taxes to the best of your ability, and especially if you have a CPA supporting you, you really shouldn't have any errors in your tax return or anything beyond maybe like a very, very small nuances that the IRS might choose to be nitpick about, but for the most part, we'll let slide.
Speaking of auditors, I think I read that you have somebody on your team that used to be an IRS auditor.
That's right. So I think a good resource to have for any tax strategy team is having an ex-auditor on staff. The idea being they spend years on the other side of the equation. So they know, they see their peers, they see their own work in terms of what questions are being asked and what type of answers they're looking for, as well as what is kosher and what's not kosher with the tax code.
That was smart to pick that one up.
Surprisingly, a lot of IRS auditors like staying within the IRS. So it's actually quite hard sometimes to find an ex-auditor who wants to join an advisory firm.
They probably have good benefits.
So the crazy thing is, as you can imagine, the government does have some people consider the best set of benefits in the sense that you have, once you work for the government long enough, you can more or less think your retirement's secured. However, the annual salary of an IRS auditor compared to an IRS auditor consultant is vastly different. Hence, they can probably command a large premium. If any IRS auditor is watching this video and wants to find ways to make more money, this is a very real opportunity.
Yeah, you can work with David or me. I'm looking to find somebody as well. So and maybe we're going to be partnering in the future on some things.
For sure.
I like, we've been getting along pretty well. David's been doing this for a little longer than me, but he was a W-2 employee for a long time. My background, I was an actuary for 20 years, so I had the math nerd ability, and I never knew any of these strategies, and I'm definitely all in on finance. So super excited to learn about new strategies.
One of the reasons I'm very excited to get to know you more and find ways to collaborate, Jeff, is the idea that finances is such a big topic. Tax optimization, I actually think, is the tip of the iceberg, and I think it introduces so much more to people. Everything, and you might agree with me on this, a lot of things in the financial space just comes down to education and awareness. People aren't aware they can invest in things outside the stock market. They're not aware that you can find higher ROI than bond markets out there. Obviously, all of these investments come with risk, but there are niche ways of investments to really get really high returns. I think people are used to their 10, 12, maybe 14% returns from the stock market, but there's things out there that consistently produce 10, 20, even 30% annualized returns.
Yeah, what are some of the investments you've seen that consistently produce 30% return?
So I've seen it. I don't know how it works. That's the thing. Like a lot of these, I know a lot of investment firms, and they only manage family office money, so I don't actually know the underworkings of how it works. But it comes down to a mixture of quant trading firms on one side for the equity side of things, as well as volatility management. And on the other side of things, it's going to be stock alternatives, for example, your real estate, your niche deals, venture capital, private equity, blended together over large sums of money and a private deal flow. Generally speaking, 30% is not unheard of and sustainable across decades.
Just for a caveat for the audience viewers, Stock Alternatives is the name of my company. And I have invested in 2 different quantitative trading strategies. It's still early, so we'll see how they go. But the track record is kind of, if I told you, you wouldn't believe it. So fingers crossed. And, I also look at other things that just not available to the public. Like I invested in a company that is going into Walmart's with a Italy pasta company. If people want to go into that with me, we're still taking some investors. I also invested in a company that's developing a replacement for the mammogram, a company that is putting sink-side billboards in place so you can watch a little advertisement while you're washing your hands. I think that's going to go viral. And I've invested in a company that's expanding diabetes clinics that I believe will get very, very strong returns. But sometimes you have to be creative, and some of these are more speculative than others.
That's right. I think a balanced portfolio should have a little bit of everything, especially as you build your wealth and you have a larger and larger net worth. You don't want all of it in purely stock equities, and you definitely don't want all of it in bonds or all of that nature. You want to have a little bit of everything to maximize your return while also protecting your downside risk. There are specific investments out there built for downside protection or benefit off of volatility spikes. So I know, for example, my older clients who are roughly in that 65 plus territory, they're very ready for retirement, if not already retired. And they just want to make sure they have their nest egg last as long as possible. And that they're, a lot of people, there's a lot of news on the internet nowadays about like, oh, is AI going to cause the next bubble that leads to the next recession? I don't know, but I do know that at some point, like market corrections are ordinary, roughly speaking, once every decade. And it just becomes a cycle that happens somewhat pretty on clockwork, maybe not necessarily exactly every 10 years, but roughly speaking, there's a cycle of assets being overvalued, assets being undervalued, and everything in between. And there are strategies specifically that help people sleep well at night. And I think at the end of the day, more than the optimal savings, for some people, they want peace of mind, and that also exists in the space of stock alternatives.
All right, so I'm going to change gears topics a little bit. People have heard of 1031 exchanges. Is that easy to do, difficult to do, and how does that strategy work? And is that something you work with?
Yes, it is. I don't know if easy or difficult is the way I would label it. It is available, and it depends on how much work someone is willing to do. So does it require effort? Absolutely. And then just to take a step back, a 1031 exchange, for those who don't know, is the idea of selling one asset and taking the gains of that asset and rolling it over into another asset that is similar in nature. So for example, the most common use case is people who buy a rental property, they use it as a rental property for a few years, it appreciates in value. They want to sell the property to acquire another rental property, but instead of paying the capital gains tax, they can instead choose to take that gain, do this thing called a 1031 exchange, and where if you follow the rules, you take the money, it goes towards a new property. So you have a new property, but you have you get to defer the capital gains into the new property. And the idea being, if you keep rinsing and repeating this cycle, eventually there comes a point in your life where you pass away, and then the people who inherit this property from you get this thing called a stepped up in basis, which means that they functionally got to get all those capital gains taxes eliminated.
And I've heard people, they'll borrow against their assets so they never have to sell anything. And then when they die, they have a step up.
That's right, yeah. So you can borrow against your homes, you can borrow against, you can even borrow against collectibles collections. You can borrow against so many things nowadays. The world of fintech is changing so rapidly. Like there's so many new ways to liquidate things that didn't previously exist. There's all these sorts of ways to have fractional ownership into these things. That I think is just really creative.
Do you know how to borrow against alternative investments?
That one is going to require a larger amount of alternative investments. For example, you don't have to have, generally speaking, if people have art collections in the tens or hundreds of millions, there are people who do underwrite and lend against that. These are not common lenders. You're gonna have to have like a specialist that operates in specifically that vertical, and they themselves may wish to have their own appraisal involved in the process. The interest rates will be higher relative to a stock-backed loan or a home equity backed loan, but they do exist. And I know there's another alternative for people who have a lot of illiquid stock. For example, if you're a software engineer, you work for you're a software startup, your company has not yet gone public, but you own a lot of shares. So there are also firms out there who will lend against it, though the interest rate can start entering the double-digit territory.
Got it. Makes sense. One of the things I learned about recently is there's a $512,000 limit if married on depreciation deductions
Yeah.
for W-2. Is that something that's particular to every strategy combined, or can that be used across multiple strategies to get it like more deduction? Like, so can you use a combination of like the clean energy and then the short-term rental and then some donations and then maybe some oil and gas?
You can combine strategies, absolutely. It will depend on someone's situation, whether they need that many strategies. I see a lot of firms out there advertising how they have a dozen strategies or 100 strategies or 1,000 strategies. The number actually doesn't matter. It just really matters like how much are these strategies moving the needle for someone's individual circumstance. And then the idea being to answer your question about that $512,000 limit, that's called the excessive business loss limit, and it applies to all business losses netted out across all of your portfolio of businesses. So if you have, for example, 400K of write-offs that come from your short-term rental, if 400K is the net loss of your short-term rental, predominantly from the cost segregation study, and you had another 100K coming in from a solar investment, those can add up to be that 500 and stay beneath that 512 limit.
Okay. But oil and gas is not part of that category, correct?
It is also part of that limit. Almost everything shares that limit
Everything has the 512,000 limit.
if it's related to a business.
And anything you don't use, you can roll forward another year.
It's actually better than just rolling forward. It turns into this thing called a net operating loss, which means that it can be used to a greater extent in future years. So for example, let's say I'm working with a client, they have large sums of income, and they want to write off $500,000 this year and using depreciation-based strategies, and they want to do an extra 500 on top of that. So let's say they have a $1 million write-off, and let's just say for ease of numbers, I'm going to round the 512 down to 500. That means they have 500 excess losses that they cannot claim the current year. That turns into 500K of net operating losses in the future that can be used for up to deducting up to 80% of their future income each year. So whereas previously it was limited to 512K for the first year, once it turns into a net operating loss, it's subject to 80% of your income as the limit.
Okay. And you wouldn't want to use 100% anyway, because you always want to keep 20% of your income and pay taxes on that.
Oh, it's not necessarily a choice. You can use them as much as you can use them. Yeah.
Can you save some of your net operating losses if you want to use for future years?
No, unfortunately, it's not like a resource that you can use as you need it. When you run your tax calculations, the net operating losses that you do have, they just automatically get applied to the maximum limit possible. So let's say the next year they had, just for ease of numbers, a $100,000 income, and they had no other deductions applied. 80K from their net operating losses would be used against their 100K income. So their now taxable income turns into $20,000, and the 420 of net operating losses they didn't use rolls forward to the future.
Okay. So it's not as useful some years and other years.
Correct. It's as useful as your future year's income.
And then on tax credits that you get from solar and EV, can you choose which years to use those?
The short answer is no. The way it works is that you take it first for the current year up until the maximum. Depending on the type of solar asset, it will have a different type of limitation. Just taking, for example, if we can use, for example, the 48E projects, those will have a limit based on this thing called the AMT spread. So once that amount, it's the difference between your current taxes and your AMT taxes. That spread is what you can use your tax credits on. And once that spread is taken up, whatever you have remaining will roll back first 3 years, then the remaining after that will roll back to 2 years ago, then what's remaining after that will apply to 1 year ago. And if you still have anything remaining, it applies into the future.
Okay. You can go with like 22 years in the future.
22 years in the future. I really hope people use it well before then, because otherwise it's just sitting capital. Yeah.
It's not earning any interest.
That's right. Yes.
I've heard some people talk about a discounted Roth strategy. So this is where you have an asset that's not very liquid, and then it gets appraised at a lower value than what you might have bought it for a couple of years ago, and then you pay the taxes on the lower appraised value. Can you talk about what you've seen in the industry for people using this discounted Roth, and if it's been challenged and if it's passed the IRS challenge?
So the idea is the fact that when you do a conversion A typical conversion of an IRA balance into a Roth IRA balance, every dollar converted is $1 of taxable income in the year you did the conversion. Obviously, suboptimal, but you do want more money in your Roth account over time. So a lot of people will do conversion at some point in their lifetime. There's ways to tweak it to make it more advantageous. On top of the strategies we've already talked about thus far in this episode, you can also stack on a discounted basis benefit in the conversion. And what that means is instead of taking a dollar taxable income for every dollar converted, you can get a discount on that, somewhere in the tune of 20 to as high as 80%, depending on which asset class you're choosing to invest in. The way it works is you're allowed to, when you have an asset, it'll go through a life cycle. So for example, let's say I had $1 million and I buy land. This land could then be used to build a project. And then in the middle of construction, certain expenses have already been incurred as well as the project is midway through. Generally speaking, projects that are partway started but not yet finished have a lower valuation relative to the starting point. So for example, the value of this project, if it started off as $1 million, it might be lower now. It could be, for example, $650,000 in valuation. And if that were to be evaluated by an appraiser, you can take that appraisal report, bring it back to your IRA custodian so they can properly update the value of your account. And then after that, you can tell them, I want to do conversion. So now instead of converting $1 million in the eyes of your custodian, you're converting $650,000. So when your custodian files the paperwork to the government, they see a conversion of $650,000, not a conversion of $1 million. That said, the underlying asset is still worth something. And then if you give it a few more years, the real estate project completes, and then you have these excess, all the on-paper losses, get back, the value is restored in full. And if not, it's going to be, typically speaking, some in the range of 10 to 15% more in terms of annualized return once the project is done 3 to 5 years later when it's sold to the next investor. That allows you to get all the gains in your Roth account and only be taxed on a conversion of $650,000.
I've seen this before. I had a buddy who would do this with structured settlements. So when someone has a workers' comp claim, they get a structured settlement that they're going to get paid a certain amount for the rest of their life. And you could buy that maybe at guaranteed by an insurance company. You might get it at a 5 or 6% interest rate. And then he would go to like JJ Wentworth or one of these companies that tries to buy these things, and they might appraise it at like a 20% interest rate because they're trying to get a better deal than you got. But you can use that appraisal value to basically Roth convert on maybe 50 cents on the dollar to what you paid for it. I've seen it with life settlements. I've seen it with oil royalties.
That's right, yeah. Oil and gas and real estate are the two categories I'm aware of for those discounted Roth conversions. They do have different timelines and different risk factors, obviously, but at the end of the day, a discount of 35 to 50, possibly even as high as 65% in terms of discount with real estate and up to 80% using oil and gas is not bad.
Is there a certain amount of time that you have to hold the asset before you get it appraised to kind of avoid scrutiny? Like I would imagine if you bought it and you got it appraised a month later, it's not going to hold water, but you probably have to wait a certain amount of time.
It's not so much the time that you have to hold the asset, because a lot of people hold land for many, many years before they develop on it. It's more so you want to choose the lowest point from your perspective to get that conversion in at. So there's certain points where in mid-construction, a lot of soft costs have been utilized. For example, there's a lot of money that's spent in the starting of a real estate project that aren't necessarily part of its valuation. They help improve the valuation long term, but in the moment, it's just considered a cost and not necessarily an asset. And that leads to a decrease in the valuation of the project relative to what you invested. And generally speaking, it's going to be like at least half a year into construction.
Got it. And do you have a partner that you work with for discounted Roth conversions?
There are multiple, and then depend on the asset class that someone prefers. Oil and gas offers a higher return, but the return timeline is a lot longer. So generally speaking, 8 to 10 years. And if people are doing this for the sake of Roth conversion, you generally, if you have 10 years before you're going to retire anyways, not a big deal. But then something to keep in mind is every dollar locked into an asset is a dollar not available to invest into another asset. So I prefer quicker turnaround times, and there's real estate projects that can be done as quickly as 2 years, but in general more closely 3 to 5 years to do that conversion. And then that allows you to then sell out of the asset, choose other asset classes that have a higher ROI, and then focus on building the value of the Roth versus purely just focus on the front end.
Yeah, we should share like who our partners are for the different Roth conversion strategies and try to find the best ones and mix it up to some extent. And for people who are listening to this, if you got this far, congratulations. Yeah, we could help you find good Roth conversion strategy partners as well. So that's part of, we spend the time to do that for you, and you don't have to spend the time to research and learn all that, and then you can take advantage of the benefits. So, all right, what other questions did I have? I wrote a bunch of questions ahead of time. Talk about the use of leverage versus not using leverage in short-term rentals. Is it required that you use leverage, or are there ways to do it without using leverage?
You don't need to use leverage. And there's also ways where you don't use leverage, but there's another party that uses leverage. There's all sort of creative structures. The cool thing about this space of tax advisory is that if someone can come up with a tax strategy that's compliant with the tax code, it becomes very popular quite quickly. And I think the converging opinion is that it makes sense to use leverage for real estate, especially when you know that it has a certain confidence interval for how much cash flow it's going to produce, allowing you to choose the right amount of down payment. Me personally, I don't like recommending below a 10% down payment just because the monthly rate is just going to be higher and the interest rates aren't necessarily great right now. But somewhere between a 10 and 30% down payment is what most of my clients will do for a short-term rental. Obviously, the lower the down payment, the lower the positive cash flow, the higher the down payment, the higher the positive cash flow. Ultimately, you want to look at what your cash on cash returns are, as well as your overall returns, as well as what you're eligible to get. Because sometimes people want to put 10% down, but they're in a situation where the banks will only lend for 20% down or 25% down.
The banks have to get on board, and if you go below 10%, the interest rate's going to be really high.
Yeah, and I think about how my natural inclination, just for myself, is that I want to maximize the ROI of these investments, and hence I personally prefer to use leverage. Leverage is one of those tools that helps you get a lot of tax savings using other people's money, and I think one of the core concepts of financial optimization is use other people's money as much as possible when it serves your needs in a way that's defensible from a compliance standpoint, as well as predictable from a revenue standpoint. And if you have those check boxes, I'll take leverage every day.
Me too. As long as I know that I'm going to get the cash flows from the investment.
That's right, yeah.
I'm very comfortable with the leverage. Tell me about your experience using like trusts or charitable foundations or like life insurance.
Yeah.
Is that a common strategy, and should normal W-2 people making about $1 million be considering those, or is that for like even richer people?
The strategies are available. It just really depends on what an individual's goals are. I do find that people will generally want to be making a lot more money before they start considering insurance-based strategies. There are strategies where you can make an investment into a life insurance policy that's backed by the stock market. So the idea being you can participate. The premiums you pay, a portion of those premiums gets put into the market, and not just into a raw equity, but it's put into a specialized option, if you will, that protects your downside, but allows you to have a decent chunk of upside. And you'll want to choose a good partner for this. This allows you to have a lot of value in your insurance policy down the line. If you were to fund your policy this way for many years, especially if you're willing to use things like leverage, 10, 15 years down the line, your policy has quite a large net worth, and you're allowed to borrow against your policy. So that is a non-taxable event. You can pull money out of the policy. There's no capital gains associated with that. And that functionally becomes tax-free money available to someone later in life as part of their retirement plan. Some people prefer this over using a 401k or an IRA just because the limits are a lot higher. There's functionally no limit, barring as long as you stay within the compliance territory, allowing people to get relatively large benefits. I don't typically work with trust structures for my clients, but I do know they exist in the industry, and a lot of people will choose a variety of charitable trust structures where they'll take an asset that they've been holding on for a long time. For example, a Google employee might have been around for 10, 20 years, have a lot of low basis stock, and then instead of wanting to pay capital gains taxes on that, he can choose to set up a trust structure where he takes some of that amount each year and pays taxes on just the amount that he wishes to take out. And then at the end of a certain time period, the remainder gets donated to charity, and he gets an initial upfront deduction based on some actuarial math on that, which you probably know a lot more than myself.
Yeah, actually, that was a new one for me to learn as well. So it it's pretty impressive what can be done.
I think a lot of people underestimate what's possible. So I think it doesn't matter who's out there. Talk to somebody who's an expert in this space. If you're making north of $500,000, there 100% is a way that you can be paying less in taxes legally.
I think this has been a great conversation, David. I think we touched on most of the important questions. If anybody who's listened to this whole thing, they have a month's worth of education in 1 hour. So I really appreciate you coming on. Is there any other questions or thoughts that you had that you wanted to share before we conclude?
We covered about everything.
All right, very good. Good job. And if you want to find David, what's your website, David?
primepathadvisory.com. So that's PRIME advisory, or PRIMEPATHADVISORY.com.
If you want to find me, stockalternatives.com. We're sort of competing on things. We're doing the same sort of strategies. David's been doing it longer. I met him because we had an EV charger battery strategy, and he wanted more information on it to potentially use it down the road. So, but this is a small world, and whoever you end up using, whoever you end up talking to, you'll get good advice from David or from me, and we can help you save taxes significantly. Just one more thing to conclude. Like, what does your typical client save in taxes, and how much do they have to spend to save that?
So the numbers I keep in mind are typically the net savings numbers. So after you account for all the fees, after you account for what they pay me, after they account for all the investments, I generally want to see clients saving $100,000 or more. Generally speaking, it's going to be in that territory of $100,000 to $500,000 in net savings is generally going to be the more or less. I want to maximize the savings for my client. So it really depends on their situation, but about $100,000 to $500,000 is a pretty typical amount of savings for a lot of the clientele that we serve.
Yep. And what would that be as like a percentage of their taxes?
From an effective tax rate, a lot of people are going from roughly the 40% territory to the 20s. So functionally about like a half reduction to a third to a half reduction, depending on their unique circumstances.
Awesome. All right, David, I really appreciate talking with you. We look forward to more conversations.
You as well.
And tune in to future podcasts with Stock Alternatives.
Thank you for listening to the Stock Alternatives Podcast with Jeff Stock. At the end of the day, wealth is determined not only by how much you earn, but also by how much you keep through smart tax strategies. For business owners, retirees, and high-income professionals seeking greater returns, steady income, tax relief, purpose-driven investments, and portfolio diversification, visit stockalternatives.com to learn more or schedule a personal meeting with Jeff Stock.